Paisalo Digital. Mr. Santanu Agarwal, the Deputy Managing Editor of the company, joining us on the show. Mr. Agarwal, hi, good afternoon, and good to be speaking with you. First of all, let's start by talking about the kind of quarter that you've seen. Your NII and PAT have declined sequentially, even as the AUM has seen a 10% sequential growth. Can you help us understand if this is a one-off funding cost spike from the borrowing ramp-up, or should we expect this kind of margin pressure to persist in the second quarter as well?
First of all, we are very pleased to share that Paisalo has delivered one of its strongest quarters yet across growth, distribution, technology, asset quality. And we believe the momentum we are seeing is not just continuing, but building. If you see on a year-on-year level, we have posted about a 16% increase in net interest income, about a 30% increase in PAT, 28% in AUM. Normally, comparing Q1 and Q4 is not the right benchmark for us historically. However, to answer your question, generally there is a lag between debt issuance and conversion of funds into loan books. And hence, it was a transient impact in Q1. In Q2, we are raising funds through NCDs, and hence we may not have that impact. But at the same time, there is some FCCB conversion also likely taking place, which will help us in normalizing of the cost. So overall, we don't see any major impact in the quarters that's ahead, except for some time lag between raising funds to deployment of funds.
Mr. Agarwal, on that note, I just have a follow-up on the margin front. Your yields have softened to 16.7%, while cost of borrowing has also declined. Do you expect spreads to remain around that 6.5% mark, or will competitive pricing begin to compress your margins going ahead?
No, we are trying to, optimize our borrowing cost through diversification of our liabilities in order to accelerate and scale up our loan book. Our endeavor is to maintain the NIMs at a current level, as we have continued to guide that we are maintaining the NIMs at about 6.5%. So, yeah.
6.5% on the NIM front, we'll be watching out for that, and that's what you continue to guide. And since you've mentioned, your quarterly disbursements are at a record level. They've more than doubled on a year-on-year basis. Can you talk to us about what were the levers at play, and how sustainable is this momentum for the rest of this financial year?
So if you see in the last couple of quarters, our touch points have gone from about 5,299 touch points to 5,995 touch points, which is an increase of roughly 696 touch points. And we have also added 6 new product lines in the last one quarter itself. This is exactly that terrain on which we believe Paisalo is built to win. So the sharp increase in disbursements was primarily driven by what we have been doing for the last few quarters, that is execution of our deep penetration and through our increased touch points, which brought the strong demand from the MSME and SME segment specifically. Going forward, while quarterly growth may normalize from this exceptionally high base, the company expects healthy momentum through FY27, supported by a continued expansion and robust credit demand, all the while ensuring that our asset quality remains stable.
Okay, and that's exactly my next question to your asset quality. You've touched upon that. That also continues to improve even as disbursements have accelerated sharply. Any stress, any early signs of any stress visible at all? But you did say that asset quality will continue to accelerate, in fact improve from here. But any stress, any signs on ground?
We believe that our established origination capability, strong borrower engagement, and disciplined underwriting. So Paisalo is best placed to lead this next phase of growth and value creation for our stakeholders with good and stable asset quality. We have, since our inception, a history of credit cost we have also presented in our investor tech this time. Except for COVID times, our credit cost has remained largely below 2%. And if you look at the last 5 years, it has been well below 1%. This is achieved due to our strong underwriting capabilities and abilities that we have built over the last many years. And we are confident of sustaining this trend moving forward. We are not entering any unknown territory or product until the same is tested through our 30-year framework.
Okay, and you've also indicated that you're evaluating acquisitions in retail and personal lending NBFCs. Given the stress that we've seen in parts of unsecured lending, how do you plan to mitigate that?
So we are not looking for any acquisition of any personal loan portfolio or any specific NBFC which is focused on the personal loan space. We are looking for opportunity or portfolio buyouts where the lending has been done for income generation. Whether it is secured or unsecured is a secondary matter for us. We believe that we have a better ability to recover dues if the credit that is being deployed by the acquisition or the portfolio buyout is for income generation.
Understood. And on that note itself, you've added about 696 new touch points and about 1.8 million new customers this quarter itself. How much of that is the unseasoned book? In fact, what's your typical time to delinquency for customers acquired in a new geography?
So most of the additions this quarter are naturally part of the unseasoned book, giving the rapid expansion in the touch points and the customer acquisition. However, our underwriting framework, secure lending focus, and distribution point-led origination helps us manage early credit risk. We typically monitor cohorts closely during the first 6 to 12 months, depending on the category of the customer base and the end use of the funds that we are funding. As this is when delinquency trends typically becomes very evident for us. Early portfolio indicators remain within the expectations, and we'll continue to prioritize portfolio quality over aggressive growth as these new customers and touchpoints mature.
Okay, understood. That sounds good. We hope to keep interacting with you going ahead as well. Thank you so much for your time today, Mr. Agarwal.
Thank you. Thank you.
Thank you. Thank you.